against the greenback. Let's get more. Chris Weston standing by at IG Markets in Melbourne. Chris, great to see you there this morning. First of all, let's take a look at what happened over the night in the United States and how that's going to flow through to our market today. It is all about the US Federal Reserve at the moment. Now, interesting to note, we saw a pretty sharp drop in the Dow. I've seen it estimated anywhere between about 100 and 150 points on the back of an article in the Financial Times basically suggesting that Bernanke is going to taper in September. Incredible, because it didn't quote any sources or suggest there were any leaks from the central bank itself. It was simply an opinion piece, and yet we saw a sharp drop-off in the Dow. Are markets or investors just getting too overly sensitive to this kind of information now?
Yeah, look, they are. I mean, it's going to happen. We're getting into that crescendo period now where in the next 3 or 4 days, I think are highly critical for the bond market. I think they're highly critical, therefore, for different indices around the world, especially in emerging markets. If we do see yields pushing higher, they're going to see big outflows of different emerging market currencies, emerging market indices as well, and they're going to be on tenterhooks, especially in China. And it's going to be key. I mean, we had a situation where Fed members were the ones pushing markets around. Now we're seeing journalists pushing markets around. You know, we'd have to see an article on Sky giving your opinion and see how markets react to that. It'd be interesting to see what goes on there. But we are seeing a very nervous market. And unfortunately, Robin Harding, who's the actual author of this piece, came out in a tweet towards sort of last hour or so in the US markets and said, people, you need to chill out. I don't know anything. This was an opinion piece. And that's all it is. You know, the Fed have a blackout period a week before the meeting. They're not allowed to speak to the media. I don't know anything more than anyone else. And like you say, it was a purely opinion piece, and that's why the markets rallied into the close. But if you actually look at the bond market, we saw the 10-year trading from about 210 basis points up to 217 basis points. And as soon as that market started moving up, as people started selling out of US Treasuries, that was the key there. That's where people came out of equities. That's where you saw that big drop off in the Dow. You know, he doesn't know any more. He doesn't know more than anyone else. But I think what we've also got to see is this big differential between his piece, where he said that this, where they could give a continued hint at near-term tapering, and compared to that, the article that we saw towards the back end of last week from John Hilsenrath at the Wall Street Journal, where he came out and said that the Fed could look to push back on expectations. What we can see is the big correlation between both articles, the Wall Street Journal and the FT, is that the Fed are going to do their utmost to make a clear differential between tapering, i.e. the idea that they're going to cut their 85 billion, and an increase in the Fed funds rate, which isn't going to happen for 2015, perhaps even 2016 in most analysts and economists' eyes at the moment. So that's what they're going to be doing. They're going to make this clear differential between tapering and the increase further down the line in the Fed funds rate, because the market seems to have got a little bit confused as to what exactly the difference is between the two. And I think the good thing about from Robin Harding's article is that if you look at the second paragraph, he makes a clear case that the market's just lost in this communication exercise, that the communication exercise from the Fed seems to be broken. And the key message, and what people should really understand, is that tapering of the asset purchases is a good thing for the economy. It shows that the Fed believe that the market is strong enough to stand on its own 2 feet, and the market doesn't believe that for one moment at all. So, yeah, it seems like the communication channel is broken. So I think there's a difference at the moment, but clearly, you know, in the next 4 days or so, after the next 4 days, I'd say we're going to have a much clearer idea of what the Fed stand to do, and that's why we're seeing this increased volatility and headline risk at the moment.
Yeah, certainly Hilsenrath and Harding. I mean, you want to read their columns if you want to get an interesting perspective on what the US Federal Reserve is doing. But as you mentioned there, they're both basically looking in different directions. It's not based on any leaks or any sources. Harding admitted that in his tweets a little earlier. Why do markets react so incredibly to these kind of comments out from these US Fed watchers? I mean, they were really stating the obvious.
Well, first things first, I think we've got a lot of algorithmic traders in this market, Kate, and they react to headlines. You've got a lot of investment banks which have programs which are set to react to headlines and interpret them through keywords, and they can react a lot quicker than you and I. That's the issue. If we see an article coming out, you see these markets react in a millisecond, and that's ultimately what we're seeing at the moment. There's a lot of algorithmic traders which are set to react on these headlines and interpret that. But I think if you take a step back, the reason we're seeing this increased volatility is we are absolutely changing from a market which has been completely stimulus-led OK, fine, we've had some very strong corporate earnings, balance sheets are very good in the US, etc., etc. But we're changing from what's been a stimulus-led recovery and a stimulus-led equity rally and bond market rally, I suppose, to a degree, to one which is going to be based on more traditional fundamentals, based on growth metrics around the world. And how that feeds into organic growth for these companies. And that's always going to be a bumpy ride. It's never going to be a smooth ride as we revert back to those fundamentals. And that's exactly what we're seeing. Markets are trying to second guess as to what's going to happen with tapering, what's going to happen with the bond market. Can equity survive with a much steepened curve? And that's the key issue that we need to be sort of looking for as investors. We are going to see a steepened curve. Jim O'Neill, who used to be the chairman of Goldman Sachs, came out over the weekend and say, markets will have to get used to potentially 4% interest rates in the US. What that means for Aussie rates and other bits and pieces is not so clear cut, but we're going to see a much steepened curve. And equity investors need to work out what's going to be the best places to be over the next 24 months if we do see a continued steepened curve. And of course, financials and insurance companies would probably be that place.
Yeah, Chris, you mentioned the algorithmic trade that's going on at the moment and how that probably plays a big part in the reaction we've seen to these kind of articles. Just for people who don't follow this so closely, perhaps you could just explain how this technology works. It's basically scanning everything on the internet, isn't it?
Well, there's different types of algorithmic traders out there. I mean, we can set client. I mean, we don't prop trade for clients here, but you can actually have programs which run just to follow things like VWAP. The average price throughout the day and just track it and get fills around those side of things. But they're the sort of algorithmic traders we're seeing from a lot of these investment banks, which are the ones which are so controversial in the markets, is that they can set programs to react to keywords and interpret them in such a way that you might get James Bullard, who we know is Dove, for example, that comes out with ultra hawkish comments, and you can have a button which comes out and goes into the market in a certain asset class and either buys the US dollar, looks to sell off US bonds or buy the S&P futures or whatever it's going to be, and they can react to these certain words in milliseconds. And that's, perhaps they get that situation wrong and then they have to backtrack.
It sounds fraught with danger.
Well, I think it's just, people are very anti. I mean, a lot of the long-only equity managers are very anti this kind of type of program. Unfortunately, it's something that we're going to have to get used to around situations where you are getting these clear diverging views as when the Fed should look to taper. Are we going to do it in Q1? Are we going to do it in September? Perhaps, God, we could do it in June. Who knows? You are going to see these different variants in opinions create volatility, and that's what makes a market. But in terms of these algorithmic situations, it's something that there may be heightened regulation, but they're not going to go away. They're not going to get banned, and unfortunately, it's something that we have to get used to.
OK, Chris, opening calls today looking pretty flat at the moment, perhaps a little bit of an uptick, but we are still trading at about 1 week highs right now. What are local investors going to be mulling when we open up?
Well, I mean, there's a lot to look out for over the next 24 hours. I mean, just on an economic data side, I mean, the RBA minutes, I can't see them being a big surprise. And we're looking at a statement previously that was about 5 paragraphs long. I don't know how they're going to be expanding on that. It was tiny, so I don't see anything major in that. Probably the China's data today is going to be very interesting. We've got the leading indicators. We've got the property prices coming out at 11:30, and of course, everyone's been talking about the backing up in short-term rates in China. That's the big story there at the moment, and the credit crunch. And at some stage soon, we're going to have to see the Chinese authorities, the PBOC, coming in with some liquidity exercises, perhaps through reverse repos and putting liquidity back in the market. Although I personally believe they're quite happy with the slight backup in rates at the moment because of the credit that's available in the market. So that's one thing that people are looking at. Japan, their industrial production numbers come out a bit later on. There's a bit of information coming out from the UK and Europe with the ZEW confidence numbers later on. But we've got the market open 10 points higher, and momentum is to the upside. We've had a big reversal over the last couple of days, and most of that's been driven by bank stocks. It looks today, though, that BHP's ADR is up 0.9%, so we might see some gains out there, and we've seen a nice tick up in the iron ore price, up about 1.2% as well. So, you might see a bit of strength in some of the mining names, but hopefully it's going to be the banks that continue to drive this market. That's where the real strength's been over the last couple of days.
OK, Chris, just quickly, interest rate outlook, you mentioned those minutes will get out today. The very short statement we had last time, I think it was about 340 words all up, so hopefully we'll get it fleshed out, or that decision fleshed out a little bit more for us this time around. But what are markets pricing in at the moment in terms of the chances of a rate cut next month?
Yeah, it's come right down, actually. I mean, it was last week or so it was about 49%. It's come back down to about 20 or about 25%, around those kind of levels, which I think is probably about fair. I mean, if you see what's happening with the slight pickup, the stabilisation, the Nikkei now with the bullish outside day yesterday, we've seen people, I think it's just reflection, and I think that's probably about fair right now. I mean, we do know that there's a few people calling for a rate cut. But I think if you look at the statement, it was very finely balanced, didn't really give any near-term concerns about cutting. So, yeah, about 25% around this is what the swaps market's pricing in at the moment.
OK, Chris Weston, IG, thanks for joining us this morning.
Thanks, Kate.
Chris from IG.